As we continue to grow together, I would like to ask you one simple yet very important question regardless of age. Have you thought of your retirement age, or are you saving for retirement? If you are just now starting to build up your retirement nest egg, do you ever ask yourself, how do I decide where to save for my retirement? And how much do I need to save for my retirement? Well, my friends, that depends on how much you want to have at retirement and the age you are when you start saving for retirement. Unfortunately, with high cost of living, Medicare is not guaranteed anymore, so saving for your future self is a must. In today's video, we will compare two very common retirement savings plans, but let's make this clear. I am not a financial advisor or investment advisor or accountant, and everything I say here is what I have read from doing my research, which any WeMatch channel subscriber can get for free in the links I will attach below. And before we continue, please hit that like button, and if you have not subscribed, go ahead and do that now, and don't forget to share the video. So first, let's start by explaining the difference between Roth IRA and 401k plan. Roth IRA versus 401k. According to NerdWallet, Roth IRA tend to be more attractive because you as the investor can invest after-tax dollars, meaning you've already paid taxes on the money you invest in your Roth IRA account, and hence you will enjoy tax-free growth and withdrawals. What's the biggest deal about the Roth IRA? You pay no tax when you get your money back because you have already paid tax on it. It's that simple. An example of this is, imagine starting to save at 33 years, and you save $500 per month for 30 years at a rate of 8% return. You will have $1.48 million at retirement by you putting $180,000. This $1.48 million will not be taxed again when you take it at retirement. In a traditional account saving at the same rate, you will have put close to $180,000 to $200,000, but you will pay tax on it later before withdrawing, meaning that you will pay the taxes before you get any penny out of the account. In Roth IRA, you get all the $1.48 million, a difference of close to $400,000. NerdWallet has listed a lot of pros and cons of each, as you can see, but first, Roth IRA pros are as follows. 1. You enjoy tax-free growth on your investments. Since you paid taxes up front, you don't have to pay when you withdraw at retirement. 2. You are not subject to required minimum distributions, meaning you never have to make withdrawals. 3. You can withdraw your contributions penalty-free at any time. 4. You have diversification in retirement, so all of your accounts aren't tax-deferred. On the opposite spectrum, Roth IRA cons are as follows. There is no tax deduction, as you pay taxes before depositing the money into a Roth. There is an income limit to contribute. For example, your modified adjusted gross income must be $144,000 or less for single tax filers in 2022 and $153,000 in 2023, and under $214,000 for those married people filing jointly in 2022 and $228,000 in 2023, but this may change over the years. According to Charles Schwab website, if you file taxes as a single person, your modified adjusted gross income must be under $153,000 for tax year 2023 and $161,000 for tax year 2024 to contribute to a Roth IRA, and if you're married and file jointly, your modified adjusted gross income must be under $228,000 for tax year 2023 and $240,000 for tax year 2024. The maximum total annual contribution for all your IRAs combined is: for tax year 2023, $6,500 if you're under age 50 or $7,500 if you're age 50 or older. Tax year 2024, $7,000 if you're under age 50 or $8,000 if you're age 50 or older. With the passage of Secure 2.0 Act, effective January 1, 2024, you may also be eligible to contribute to your Roth IRA using 529 rollover assets. Traditional IRAs do not qualify for this option. It's recommended that you consult with your tax advisor for guidance on your eligibility. While you can withdraw contributions, you can't withdraw earnings before age 59 and a half. Keep in mind that the maximum contribution is relatively low. You'll still need other retirement vehicles to save enough for retirement. The following are the general pros and cons of a 401k according to calculator.net. And like I said, you will get the links below and you can calculate your expected investment returns using both Roth IRA and 401k. Please remain studious and do your due diligence, but let's keep going here. Here are the 401k pros. Earnings on interest, dividends, or capital gains accumulate tax-free. This gives these retirement plans an advantage over other methods of saving for retirements, such as cash, active investing accounts, or real estate. You get free money because the employer matching 401ks are known for often including an employer matching program. Many employees would prefer to take a pay cut for a higher employer contribution to their 401k. Contributions to traditional IRAs and other retirement plans may or may not be tax deductible. On the other hand, contributions to a 401k, both from employees and employers, are always tax deductible because they reduce taxable income and lower the total taxes owed. High contribution limits 401k have relatively high annual contribution limits. For the year 2024, the limit is $23,000 for those under 50 and $30,500 for those over 50. On the other hand, the combined annual IRA limit is $7,000 for those under 50 and $8,000 for those above 50. Lastly, 401k funds are generally protected from bankruptcy. 401k cons, on the other hand, are as follows. Generally speaking, 401k have few investment options because they normally originate from employers. They are limited to what is offered through employers' 401k plans as compared to a typical, taxable brokerage account. Due to administrative costs, 401k plans charge higher fees, sometimes as a percentage of funds. The plan participants have little or no control over this, except to choose low-cost index funds or exchange-traded funds, ETFs, to compensate. For all the contributions and earnings over time, 401k funds can only be withdrawn without penalty in rare cases before 59 and a half. Employers may utilize vesting periods, meaning that employer contributions don't fully belong to employees until after a set point in time. This can hurt the employee if the employee decides to leave that job prior to the end of the vesting period. For instance, if an employee were to part ways with their employer and a 401k plan that they were 50% vested in, they can only take half of the value of the assets contributed by their employer. Some employers don't allow participation in their 401k until after a waiting period is over, usually to reduce employee turnover. The waiting period can be 6-month waiting periods, which is common, but 1-year waiting period is the longest waiting period permitted by law. Well, my friends, those are the differences between Roth IRA and 401k plans. I hope this helps you clarify a few things. Please share the video, like, comment, and subscribe to the channel. A link to the sources of information is attached below for those that prefer to read more. Thank you, and see you in the next video.